Welcome to Informed Investor. Dixon Technologies Limited, a leading electronics manufacturing services company, recently reported strong financial results for the fourth quarter of FY25. But despite the stellar surge in net profit and record revenue growth, its shares plummeted nearly 6% today, sparking debates among market participants. So what's going on here? Let's unpack the story behind the numbers, explore Dixon's business model, review its latest financials, and explore the road ahead. Founded in 1993, Dixon Technologies has grown from a small electronics manufacturer to one of India's largest manufacturing companies. It specializes in design-focused end-to-end manufacturing solutions for consumer durables, lighting, and mobile phones. Over the years, Dixon has expanded its portfolio and client base, becoming a key player in India's electronic ecosystem. The image on the screen shows how they ventured into different product lines over the years. Starting off with color TVs in 1994, they've expanded to several products over the years. Their product portfolio includes consumer electronics like LED TVs, home appliances like washing machines, lighting products like LED bulbs and tube lights, downlighters, mobile phones, CCTVs, set-top boxes, medical equipment, and wearables. Today, it operates 17 manufacturing units across India, employing over 15,000 workers. Talking about the different segments of the company, Dixon's operations are broadly divided into four key segments. Mobile and other electronic manufacturing service division accounts for the lion's share of revenue to the company and the growth engine, followed by consumer electronics and appliances. Then comes home appliances and lastly, lighting products. Another point to highlight is that Dixon Technologies has been a big beneficiary of India's Production-Linked Incentive or PLI scheme, which supports domestic manufacturing of electronics. The PLI has significantly boosted Dixon's growth and profitability. However, the scheme is now expected to expire by Q4 of FY26, raising concerns about future incentives and competition. Now let's quickly run through Dixon Technologies Q4 FY25 numbers, and they're pretty impressive. First off, revenue or income more than doubled, hitting 10,293 crores, a 121% increase from last year's 4,658 crore. Then EBITDA rose 128% to 454 crore, with margins improving to 4.4%. So they're growing and becoming more efficient. Profit after tax jumped to 465 crore, up 379% up from 97 crore last year. That's huge. This thereby led to PAT margin improving to 4.5%. But a point to highlight is that the PAT surge was driven by a one-time gain of 250 crore from the sale of 6.5% share in Aditya Infotech Limited. Excluding this exceptional item, the PAT grew by 157% year-on-year. Now looking at the full year of FY25, revenue increased 120% to 38,860, while the bottom line profit grew 229% to 1,233 crore. Now in terms of segmental performance, mobile and other EMS divisions witnessed a 203% increase in revenue for the FY25 compared to the previous year. This segment has been the growth engine for the company. Second, consumer electronics and appliances, which include LED TV and refrigerator, witnessed a decline of 13% in revenue for the year. Home appliances, on the other hand, witnessed an increase of 13% year-on-year. And lastly, lighting products saw an increase of 9% in revenues for FY25, with an increase of 3% in operating profit. If you look at some key financial ratios, return on capital employed stood at an impressive 48.5% compared to 38% in FY24. Return on equity adjusted for the exceptional gain during the year stood at 32.5% versus 25.2%, all indicating efficient capital utilization. Additionally, gross debt declined year-on-year to 0.07 times, improving the balance sheet strength. Net debt also reduced to 0.02 times, indicating better cash flow management. Now, why did Dixon fall despite these strong numbers? Despite these strong numbers, the stock fell because of a one-time gain which inflated profits. Without the 250 crore exceptional gain, growth looks slightly less spectacular. Secondly, valuations have stretched, with it currently trading at a PE of 123 times, while the industry PE stands at 31 times. To add to this, the stock has seen a considerable surge in the last 5 years. Dixon has surged around 1,700% over the last 5 years, making it expensive. When the results hit, many investors saw it as a perfect moment to lock in gains. think of it as a sell the news moment. Lastly, the PLI expiry concerns also are weighing in. Investors fear margins may shrink post FY26 when the incentives dry up. Now moving ahead, there is growth on the horizon for Dixon Technologies. The Vivo JV and the Pixel smartphone production for Google from September 2024 will boost mobile segment revenue. Secondly, the rising urbanization and premiumization trends in the TV and refrigerators will also drive demand, thereby benefiting Dixon. Dixon will also benefit from the Make in India push. However, there are risks to monitor. Due to the PLI expiry, margins could contract by 60 to 70 basis points if integration efforts lag. Global giants like Foxconn and Wistron are expanding Indian operations, threatening Dixon's market share. All in all, Dixon Technology remains a high-quality play on India's electronics manufacturing boom. However, short-term volatility is likely due to profit booking and PLI concerns. What do you think? Will Dixon bounce back or is the rally over? Let me know in the comments below. Now moving on to some other important market updates. State-owned hydropower giant NHPC Limited reported a strong 52% year-on-year jump in consolidated net profit to 920 crore in the fourth quarter of FY25, even as margins took a hit. Revenue rose 24% to 2,347 crore, but EBITDA slipped 5.3% to 1,090 crore, dragging margins down to 46% from 61%. For the full year, profit fell 15.2% to 3,412 crore. The board recommended a final dividend of 0.51 per share, adding to the 1.4 rupees interim payout made earlier. Next up, Hindalco Industries posted a stellar fourth quarter FY25 with consolidated net profit rising 66% year-on-year to 5,284 crore. Revenue jumped 15.8% to 64,890 crore, while EBITDA grew 24% to 9,774 crore. The Aditya Birla Group firm also announced 5 rupee per share dividend and approved the acquisition of EMIL Mines and Minerals Resources Limited. United Spirits reported a fourth quarter FY25 net profit of 425 crore, up 75% year-on-year, alongside a 8.9% rise in revenue to 3,031 crore. EBITDA grew 37.7% to 459 crore, with operating margins improving from 12% to 15.2%. The company declared a final dividend of 8 rupee per share on a face value of 2, with record date August 1st, 2025 and payout on or after September 4, 2025. Bellrise Industries 2,150 crore IPO opened today with a price band of 85 to 90 rupees per share. As for the first day, the issue was subscribed 0.32 times overall. The grey market premium stands at 4 rupees per share. Bellrise Industries started in 1998, which makes auto parts for two-wheelers, three-wheelers, four-wheelers and commercial and farm vehicles. Its products include metal chassis, plastic parts, suspension and exhaust systems. Now having said that, this is me, Rahul Hassan, signing off. Have a great day and stay safe.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.